Welcome back to The Explainer. I am so excited to jump into this one with you because today we are literally pulling back the curtain on the exact mistakes that put everyday, hardworking investors on the wrong side of the macro tide. You know, it's one thing to understand how the stock market works in theory, but it's a whole different ballgame to see how it actually breaks down in practice. In this explainer, we're going to reveal the specific, hidden pitfalls that just quietly destroy beginner accounts. And, more importantly, we're laying down the real, uncompromising capital rules you absolutely must have in place to survive out there. Okay, let's dive into this because this number right here, this is the ultimate reality check, negative 86%. Now, if you caught our previous breakdowns, you know this refers to Cisco back in the early 2000s. And what's just absolutely wild about this is that Cisco was a genuinely incredible company at the time. I mean, record earnings, flawless fundamentals, the whole shebang. But guess what? None of it mattered. They still lost 86% of their value. Why? Because the macro ocean they were sailing in just got slammed by a massive, relentless four-wave hurricane. We're talking interest rate hikes, oil price spikes, 9/11, and huge corporate accounting scandals. It perfectly proves our absolute foundational rule: even a fantastic company with a bulletproof balance sheet is going to get crushed if the macro tide turns against it. Bottom line, fundamentals simply cannot overcome a bearish macro tide.
So, how do we stop ourselves from getting crushed? Well, we have to actively fight these 5 pitfalls. And let me be super clear right out of the gate. These aren't just innocent little mistakes. They are irresistible temptations that you are going to face every single time you log into your brokerage account. Let's run through them really fast. Number 1, bad timing. This is buying good companies in bad markets. It's the fundamental trap we just saw with Cisco. Number 2, bad sizing or poor money management. This is when you let a small, totally manageable 10% loss compound into an absolute account killer just because you were too stubborn to cut it. Number 3, bad diversification. Concentrating way too much capital in a single stock or sector, meaning one bad earnings call takes down your whole portfolio. Number 4 is impulse, trading some hot tip or hype you heard on TV instead of following a strict written process. And finally, number 5, bad fills. This is poor execution, bleeding your hard-earned money to commissions and slippage, which is that super annoying price difference between when you click buy and when your order actually fills. Seriously, memorize these 5 because the market is going to tempt you with every single one of them.
So the crucial point is, you need a shield against these pitfalls, and that shield is made of cold, hard cash. Let's look at the blunt math of readiness here. To actually trade this methodology safely, your absolute baseline capital floor has to be $25,000 to $50,000. Now you might be wondering why that specific number. Well, it comes down to the strict mathematics of risk capital and maximum drawdown. See, below this capital floor, a completely normal string of 10% stop-loss exits, and by the way, that's the exact kind of standard expected loss that literally every professional strategy goes through, can completely evaporate your account before your strategy even gets the statistical sample size it needs to work. The math is just brutal. If your account is too small and you can only diversify across a couple of positions, one bad sector call is going to do disproportionate damage. You'll just get ground down to zero. But capital is really just the first box to check on your readiness list. If you want to be an intelligent speculator, not just a reckless gambler, you have got to commit 5 to 10 hours a week for research and routine. You're checking the macro calendar, running screens, looking at indicators. This is not a 5-minute-a-day passive hobby. And finally, you absolutely need a fast, reliable broadband internet connection. Honestly, why does internet speed even matter? Because in this business, a slow connection bleeds real money. A delay of just a few seconds on a market order means the price can jump, and that slippage instantly eats your profit margins, and boom, you've just violated our rule against bad fills. And this brilliantly illustrates the massive difference in mindset you need to adopt moving forward. I want you to keep this analogy in your head permanently. You are a sailor. An amateur investor is a sailor who obsesses over polishing the woodwork on their boat while a Category 5 hurricane rolls in. They're staring at the company's intrinsic value, the famous CEO, the shiny products. They're just looking at the boat. But a professional checks the hurricane forecast first, every single time, before they ever touch the polish. Because here is the insight that most beginners completely miss. In a bear market, the correlation between individual stocks goes up, not down. That illusion of basic diversification, it completely shatters. You might think, oh, I'm safe, I hold 10 different tech stocks. But when macro fear hits, everything moves downward together. Macro fear completely overrides company-specific facts.
Okay, let's actually test that mindset right now with a quick, practical quiz. I want you to really lean in and think about this one. Let's say you have $15,000 and you want to start trading today. You decide to spread that money evenly across 6 different stocks to make sure you're properly diversified. So, what is the fundamental problem with this setup? Take a second. What's the big issue here? The uncompromising answer is you are dangerously undercapitalized per trade. Just look at the unforgiving math here. $15,000 divided by 6 stocks means you're putting exactly $2,500 into each position. At that tiny size, you literally cannot survive a normal 10% stop loss without materially damaging your total capital pool. The transaction costs alone will eat you alive. You are directly violating the capital floor we literally just established. And the fix isn't necessarily just to buy fewer stocks. The fix is that you need more starting capital to meet that $25,000 minimum. Or you need fewer positions that are sized strictly according to a professional risk capital formula.
So, this is where we stand, and here is your ultimate challenge. You now know exactly why the macro ocean always overrides the micro boat. You know the 5 massive pitfalls that quietly wreck beginner accounts, and you know the strict $25,000 capital floor that you absolutely need to survive normal statistical drawdowns. So here is my challenge to you. Audit your own habits. Today, look at your past trades against those 5 pitfalls and check whether your account actually meets that $25,000 floor before you risk a single trade. Because before you put another dollar on the line, you have to ask yourself, are you actually checking the macroeconomic hurricane forecast, or are you just blindly polishing the boat? And more importantly, if you did want to check that forecast right now, do you even know what tools to use? Well, that is exactly what we're going to dive into in our next explainer. I'll see you there.